Welcome to The Bell, a spirited conversation for thoughtful investors. I'm Adam Johnson in New York. Tom Essay's in Florida.
Tom, we are lucky to have you here after that hurricane. A million lost power. How are you doing in South Florida?
Hey, Adam, very happy to be with you this week. We did okay. We dodged a big bullet, but obviously still thinking about all the people along the coast that got hit. Thoughts are with them for sure.
Yeah, we certainly are thinking about them. And I hope they can join us today because we have a great podcast. Jeff Hirsch is joining us. He is best-selling author of the book Little Book of Stock Market Cycles, also the editor of the Stock Trader's Almanac. And of course, you and I are kicking it off with our order book right here at the top. We've got the third quarter earnings parade. Retirees may be getting a break courtesy the Fed, and love Italian style, those Methuselah bonds you've been talking about. So kick us off with the earnings parade.
You got it. Now, speaking about dodging bullets, Q3 earnings are starting this week, and the big question is, can we dodge a sixth straight bullet of negative earnings quarter over quarter? X energy, maybe. But the bottom line is, Adam, we do not have a rising economic tide with GDP so low. And earnings matter. Stocks have been soft the last couple of days because earnings pre-announcements have been weak. If earnings are soft, watch out.
Yeah, watch out. And by the way, retirees should be watching out, hopefully, for some more income coming their way. The Fed looks like they're going to raise rates in December. At least that's a take from the traders in Chicago. Fed fund futures are now pricing in about a 64% odds of a hike. And you know something, Tom? I'm so glad to see that because I don't want to see retirees working at Costco bagging groceries because they've got no income from these low rates. So let's get back to normal and let retirees retire, for crying out loud.
Couldn't agree more. So speaking of older things, there was a Methuselah bond. And Methuselah, as we know, was the guy who lived forever in the Bible. Methuselah bonds are 50-year bonds that are seldom issued by governments, but there was one issued by Italy last week. And guess what? It was 4 times oversubscribed. That meant it received 400% of bids for the amount offered, which is huge demand. And you know what it tells me, Adam? That we are in the midst of a still ongoing bond bubble. And I know some people disagree with that, but this tells me we're looking at some irrational exuberance in the sovereign bond market because the yield was just 2.8%. If I get 2.8% for 50 years in crazy Italy, that's all I'm getting. That to me screams irrational exuberance. Watch out in the sovereign bond market.
Well, Tom, it's time to welcome Jeff Hirsch with us today. He is, of course, the best-selling author of Little Book of Stock Market Cycles. He's also the editor of the Stock Trader's Almanac, which I don't know about you, Tom, but when I showed up at Merrill Lynch, that was standard issue along with my HP-12C.
I got the exact same treatment. Excited to have him here.
Love it. Jeff, welcome to the show.
Good to be here.
You have done a ton of work on presidential cycles. Tell us what your work tells you about what to expect over the next couple of months and quarters.
Well, the market has been tracking what we call the incumbent party winning track, agreeing with the polls out there that Mrs. Clinton is likely to be our next president. And that bodes well for the market for the remainder of the year and even into next year, where post-election years are a little bit better for Democrats. They don't tend to take big changes or make big changes right out of the blocks like the Republicans may do, especially with a continuation of the party and a sort of a similar policy agenda.
It's funny, guys, in writing in the report, I talk about politics very lightly, but I explain sort of very similar to what Jeff's talking about now as far as market reaction. And the key here for everybody is certainty. Markets love certainty. Whether that certainty is really good or bad is sort of the secondary issue. It's just let's get certainty first and then worry about everything else later.
Moving forward, right here before the election, we're getting some typical October volatility, which we see most years in October and also just as pronounced ahead of the election. I think there's some uncertainty. We've had our October surprise. I suspect there'll be more surprises from the two camps, and that tends to breed that uncertainty and uncomfortableness that you were talking about, Tom, and have the market in a little bit of a corrective phase ahead of the election.
But correct me if I'm wrong, once you get through the election, doesn't your data suggest that we usually get some sort of 4 or 5 percentage point pop?
Yeah, I mean, right after the election, within the days of it, there's usually a little bit of a sell-off or at least a softness. But then once we realize that, hey, we do have a president, we had a successful election, that things go higher. If you remember back in the year 2000, when we didn't have such a situation, we had the infamous undecided election, the market was quite weak. week. So be prepared if there are any shenanigans or something, like what happened in 2000 for the market to not have that usual rally if things don't go smoothly.
Hey, one of the things that jumps out at me, Jeff, in your work is this NASDAQ 8-month run, Nov to June. You say that's the best time to own the NASDAQ. Why is that?
Well, it's really an offshoot of our best 6 month swishing strategy, which shows the best 6 months of the year, November through April for the S&P and the Dow and the blue chips. This is something that Yale discovered in 1986. It dovetails very nicely with the sell in May and go away old British saw, which we can get into if nobody really knows what that is. But it's basically the seasonal behavior, collective behavior of society where things tend to slow down business-wise from Labor Day to Memorial Day for us, in May to September, where they come back after the St. Ledger Stake race, and picks up, the fourth quarter and first quarter. And with NASDAQ, it tends to run a wee bit longer. I think partially due to the rebalancing of the Russell, as well as the conference schedule for tech companies having their meetings and such running deeper into to later spring and early summer, tends to push the NASDAQ up a bit higher through June. We're seeing some of that impact the S&P as well, being more populated by technology than it used to be. But still, you have that fall through spring bullish period and that sort of real 4-month abyss, the July through October period, and August and September being that real consistently weak spot.
And tell us about the Probabilities Fund, because I know that you have just launched a fund in association with the Stock Traders Almanac where you put some of all this trend work to good use.
It was launched by a colleague of ours, a gentleman who, like yourself, was given an almanac many years ago, hadn't really read it, and was going on a trip and didn't have any reading material, grabbed it off his conference table and took it with him on his African safari and had nothing to read except the Stock Traders Almanac for a couple of weeks. Came back a convert for market trend following and began trading his own account, and now he has created this Probabilities Fund. So I work with them in helping them with trades, and we're also developing a seasonal sector rotation strategy, which hopefully will be rolling out into a 40 Act product, a fund at some point in the near future.
Is that Probabilities Fund, is it equities only? Is it more kind of global macro? What's the focus there?
The Probabilities Fund, the ticker's PROTX. It's a publicly traded mutual fund. It's a long short S&P timing fund. It's basically a fund of fund with ETFs where they trade different leveraged ETFs based upon the leverage that we call for in the strategy calendar each day. And they're either long or short, 1x 0 or 2x or minus 1 or 2x the S&P.
And Jeff, I know that you also do a lot of stock screening, and that's something new for you. We're actually trying to come up with individual names.
Well, we've been picking stocks. One of the first things I learned from my father when I came into the business was the price to sales ratio. And so we've been picking stocks over the years. And, we used to do a lot with the micro caps and real tiny things, but we've developed a stock screen over the years, and we also overlay it with our seasonal work. So coming here into the, best 6 months, that September, October buy point, we put out a basket of long stocks. On the flip side, in the spring, when we get our seasonal sell signal, we'll put out baskets of short stocks, also looking at different sectors that are more bullish or bearish for that particular time of year. But the screen is basically, it's not real
Rocket science?
It's old school. It's, good valuations, accelerating growth, revenues and earnings, decent margins, not too much debt. And one of the things that we look for is companies that don't have a huge following on Wall Street, aren't tracked by a lot of a super amount of analysts. We want to get a little bit of an edge and not compete with the wirehouses. So if we have two companies, all things being equal, one has 5 analysts following it, one has 20 analysts following it, we'll take them on with 5 so we can get ourselves a little bit of an edge.
There you go. Yeah, isn't that fun? I mean, in the commoditized world of Wall Street today, actually trying to get an edge by following actually good businesses, isn't that a novel idea?
Companies that are spinning out cash, decent PEs, decent price to sales ratios, nice sales growth. And the one I saw come across the news subsequent to our recommendation is CoreLogic's. we're showing some metrics for the foreclosures in the housing market. They do real estate technology and advisory services. That's got a decent valuation, price of sales of 2, PE of 23. Not as much of a hefty growth rate as the other ones, but it looked attractive to us. And that one's come below our buy limit. And again, all of this is available at stocktradersalmanac.com. There's a 7-day free trial available if people want to kick the tires. We also are proudly celebrating the 50th anniversary of the Stock Traders Almanac here. So we do have an offer out there if people want to give us a call.
Okay, time for the 3 L's. What have we learned? What are we looking forward to? And what do we love? All right, I'm going to kick it off. Beer inflation. This is what we have learned. ABI, InBev, famously bring us Budweiser, has just completed its purchase of SAB Miller, $104 billion deal. And combined market share now in this country is 67%. So if you wonder why your beer prices are going up, that's why. And by the way, they have, because shipments are down 13 out of the past 17 quarters, but sales are up 7%. So it just tells you they're raising prices. That's ugly. What are we looking forward to? Bank earnings. Bank of America, Citi, JP Morgan, and Wells Fargo all come out on Friday. Tom, you have written at length about the rotation into banks as the economy accelerates and the Fed raises rates. It's time to start looking at banks. So I'm going to be focused there. And what do we love? I love the fact, quite frankly, that Mylan has to pay a $465 million fine for bilking people on the EpiPens. There's also going to be a 23% discount or rebate on future purchases. It was wrong what Mylan was doing to families around this country whose kids, have peanut allergies and whatever. It's just, you can't charge them $600 for something that cost $100 5 years ago. So, Jeff, what do you got?
What we've learned, stick to the discipline, stick to the strategy. We did some research for Probabilities Fund about the Brexit situation and all these one-off events. And we went back and researched and found that sticking to the seasonal strategy outperformed making any changes to some upcoming one-off event like that. And luckily, we stayed short at that moment and had a nice gain when the market tumbled after the Brexit, even though the night before it didn't look like it was going that way. And what I'm looking forward to is our MACD buy signal for the best 6 months. Could actually happen any day now. And it'll be our signal to get out of any of our defensive positions and get pretty headlong into the market, into this fourth quarter rally and potential incumbent party win rally. And we're getting a little bit of help with that right here with the market selling off. And what do we love? I love recurring market patterns, trends, cycles, and history. And I also like to be breaking 90 at the golf course if possible.
All right, I'm up. What have I learned? Today I learned that you can actually put money behind the Stock Traders Almanac, which I think is pretty cool. I mean, anybody who's been on Wall Street, that knows anything knows of the Stock Traders Almanac. But it was always just, a guidebook. So the fact that people in a very easy way can get, actual exposure to these trends with the people who, know them and monitor them the best, I think is pretty cool. So that was a neat thing to learn today. What am I looking forward to? Cold fronts. I'm looking forward to cold fronts. I live in Florida. It's been 100 degrees for like 8 months, but it's finally going to get into the 70s, which is basically reason enough for me to celebrate a hurricane or not. So I'm looking forward to cold fronts. And then what do I love? I love tips. Inflation is moving a bit higher. CPI is moving higher. VTIP is a short-term TIPS ETF that we've owned since April. And in a bond market that increasingly looks like it's starting to roll over, there are not a lot of options. You want to go short duration. You want to give yourself a little bit of upside. I got a boost last week when Jeff Gundlach, who everybody knows, said he actually liked TIPS for the first time in forever. So I don't know if that's good or bad, but I think it's good. So I love tips. Check out VTIP for your bond market needs.
Roger that. We will do. And by the way, let's make sure we give people an opportunity to check out all these excellent websites. Jeff, say it again.
StockTradersAlmanac.com. StockTradersAlmanac.com.
Tom?
Sevensreport.com. SEVENS report.com. Free 2-week trial right there on the website.
Outstanding. And Bullseye Brief, my website. I am, of course, Adam Johnson here in New York, Tom Essaye in Florida, and Jeff Hirsch. What a treat to have you join us today. Thank you.